This is Dr. Trussell, and we're on Chapter 7. It's a little bit different chapter this time around, a lot more concepts related to fraud, internal control, and cash. So what we're going to do in this chapter is talk about several topics, including fraud, internal control, control over cash, how do we basically keep cash from being stolen and such, how we're going to use a bank, particularly checking accounts and bank statements and such, how do we report cash, and how do we manage and monitor cash. So we talk about fraud, which is defined as a dishonest act by an employee that results in personal benefit to the employee at the cost to the employer. And that would include things like theft. Three factors contribute to fraudulent activities. The employee feels like there's a financial pressure, say can't pay his bills, so has some opportunity to commit fraud, and then later on rationalizes it. Well, I've been with the company a long time, they owed me, that kind of thing. Back in 2001, the Sarbanes-Oxley Act was passed by Congress, but it's only for publicly traded U.S. companies, which means publicly traded means that the stock is available to anybody can buy the stock in the company. It's not privately held, which means you and I couldn't buy the stock in that company. And under that act, they had to maintain a system of internal control. Those are the checks and balances within the company that they have to make sure that the financial statements are fairly presented and nobody is stealing things, that kind of stuff. And the third part of it is the corporate executives and board of directors must ensure that controls are reliable and effective, and that independent outside auditors, CPA firms, must attest to the adequacy. They must check them and make sure that the controls are adequate. And the Sarbanes-Oxley Act, better known as SOX, created a new board called the Public Company Accounting Oversight Board, which is kind of a quasi-governmental agency that is, along with the SEC, the Securities and Exchange Commission, they monitor publicly traded corporations. So what do we mean by internal control? Those are methods and measures adopted to, these are inside the company, internal procedures and policies that you have to make sure that your assets are safeguarded, nobody steals them, the accounting records are accurate and reliable, your operations are efficient, and that the company is complying with all laws and regulations. There are 5 primary components of them, which we'll talk about them as we go along, but they are the control environment, risk assessment, control activities, information and communication, and monitoring. We're going to take those one at a time. So underneath in terms of control activities, the control environment is that you establish responsibility. It's particularly effective when one person has responsibility for a given task. If you have, say, 2 or 3 people, they're going to say, oh, well, so and so over here should have done it. Oh, no, that person should have done it. So that means also when you do that, it limits access to only authorized personnel can, say, get into the cash register. Then probably one of the most important aspects of internal control is this idea of segregation of duties. This means that different individuals should be responsible for related activities. And it also means the responsibility for record keeping of an asset should be separate from physical custody of an asset. Whoever has custody, let's say cash, who have custody over cash is different from who keeps the books. So for example, in this little example on the right over here, we have the assistant cashier who has actually custody of the cash, but there's an accounting person that keeps the books related to cash. So those duties, see, if one person had the cash and kept the books, then you just steal the cash and cover it up in the books. So that's not good. That's bad. Some more control activities include documentation. Companies should use pre-numbered documents, and all documents should be accounted for. So you can see over right here, this is sales invoices, and they are pre-numbered, and you need to make sure you keep track of them, even if it's electronic versions. And they should promptly forward source documents to the accounting department so we can make the journal entries. So if you're a salesperson, you make an invoice, make sure you promptly give it to the accounting department. Continuing on with our control activities, we have what are called physical controls. And physical controls to make sure that say cash or any other assets, you have control over those physical assets. And so these are just different ways you can do it. Safes and vaults for cash, time clocks for hours worked, computer facilities, so the pass key, fingerprint or eyeball scans, alarms, television monitors, those types of things. And then very important is the independent internal verification. We talked about before the segregation of duties, and we looked at the accounting employee on one hand, with the duties segregated from the cashier who has custody of the cash. Well, independent, so that's what we call segregation of duties. Well, independent verification means that yet a third party will verify that the balance on your books is really what cash you have in hand. So for example, the assistant treasurer could make monthly comparisons between the cash on hand and the cash per books. And then, so that person needs to be independent, just means different from one of those other two people. And then discrepancies are reported to the higher management. Human resource controls, still talking about different controls. Bond employees that handle cash. A bond is an insurance over that person. Rotate their duties and require vacations. So you don't have the same person doing the same thing over and over. Rotate the duties and require they take a vacation so they're not covering things up. And then of course have background checks. Of course, there are limitations of internal control because sometimes you just can't afford it. So you can't have the case where your cost exceeding the benefits that you get out of it. In other words, it's not free to establish these controls that cost money. Another problem is just the human element involved, in that sometimes humans make mistake in applying the limitations, and also the size of the business. If you're a really small business, it's hard to separate the duties. Let's talk about some cash receipt controls. So you are receiving cash. Then you see the little picture here, for example. You receive cash at a grocery store or whatever. How do you keep control of that? How do you make sure that the cash is not being stolen? Well, first of all, you establish responsibility so only designated or authorized personnel can handle the cash, like a cashier, for example. And you want to document the procedures using a remittance advice or a mail receipt, cash register tapes, computer records, deposit slips, etc., to keep track so you can go back and count and reconcile. And then you want to, as we've been saying, segregate the duties so that those who have the cash are separate from recording the receipts and holding the cash. You want some human resource controls as well. Again, we talked about getting a bond for personnel, which is an insurance contract. Require that they take vacations and have background checks. We want physical controls so that cash is stored in safes and bank vaults, and limit access to those who can get in those places. And again, independent verification. So whoever has access to the cache and records the cache, a third party would verify the two. It's a little more difficult when you have what are called over-the-counter receipts, like going to a grocery store where you have cash coming in over the counter. That is, a customer pays by a cash. So segregation of record keeping and physical custody is very important in this scenario. So for example, the clerk enters sales, counts the cash, sends the cash in the count to the cashier. The cashier counts the cash, prepares a deposit slip, sends the cash and deposit slip to the bank, and also a copy of the deposit slip goes to accounting. So the accounting department then agrees the register tape, remember we got the register tape, to the recorded entry, and then it goes to the supervisor and removes the locked cash register tape. And then mail receipts are another problem when you have checks or cash coming in through the mail. Normally we don't get cash coming into the mail, but you might have checks. So the mail receipt should be opened by two people. That way you don't have one person that just takes the cash or the check. And endorse the checks for deposit only. Each mail clerk signs the list to establish responsibility for the data. The original copy along with the check goes to the cashier's department, and the copy of the list is sent to the accounting department. So here's a question. Permitting only designated personnel to handle cash receipts is an application of the principle of. Well, that's establishment of responsibility. Only the key there is designated personnel. Well, let's go cash disbursements now. Cash receipts, cash coming in, cash disbursements, cash going out. And so it's very important for almost all transactions that you want to pay by check or electronic funds transfer, EFT, would be paying by a credit card, paying by bill pay, online bill pay, etc. Cash disbursements controls, very similar. Establish responsibility. Only designated personnel can sign the checks. Normally that'd be a treasurer. We make sure they're properly documented so that all, for example, the checks are pre-numbered and such. And we want to segregate duties. Those are pretty much what you want to do in cash all the time. Establish responsibility, document the procedures, and segregate the duties. We also want independent verification. So somebody compares the checks and reconciles the bank statement. It's very important that whoever reconciles the bank statement is not the same person who handles the checks or who records the checks. And same thing with human resource controls, is you bond them, require vacations, conduct background checks, and physical control where all those items are held in safes and such. Another review question. The use of pre-numbered checks in dispersing cash is an application of what? That would be an application of the documentation procedures. And what we call a voucher system. And a voucher system is basically a network of approvals by authorized individuals acting independently to ensure all disbursements by check are proper. A voucher is an authorization form prepared for each expenditure in a voucher system. It's just a fancy title for the cash disbursement system that you have, and all these different documents that are approved by various sources come together. The use of a bank is very important. It's because it minimizes the amount of currency on hand. So you're going to use checks, for example, a double record of the bank transactions, and you can have a bank reconciliation. So because the bank statement, it comes from a bank, so this is automatically external verification of the transactions. And you'll see something like a debit memorandum that's on there. A debit memorandum is something like a bank service charge, or NSF, which stands for non-sufficient funds. That basically is a check, a customer check that bounced. That would be an example there. And you can see down in this little thing right here, non-sufficient funds, $425. That would be a check that bounced. And then down here is a debit memorandum. That would be, for example, a bank service charge. Then we also have what are called credit memorandum. That's, for example, sometimes we have the bank collector notes, or there are interest earned. And here's an example of one there. The control features of a bank account do not include, be careful, we're looking for one that does not include. Okay, having bank auditors verify the correctness of the balance of the bank balance per book. Well, it's not saying that you don't have that, but that's not considered part of your control features. However, minimizing the amount of cash is, providing double record of bank transactions, and safeguarding by using a bank, those are part of control features. Let's talk about reconciling the bank account. A bank reconciliation reconciles the balance per books and the balance per bank. They're not going to be the same, and they're not going to be the true or the correct balance. So reconciling items are due to time lags. Because of time lags, they're not going to balance. A deposit in transit, it's when you make a deposit but has not yet cleared your bank statement. Outstanding check is when you write a check but it has not cleared. Maybe the vendor hasn't deposited it or it hasn't cleared your bank. A bank memorandum, like for example, when they charge a service charge, and many times there are errors either the bank made or your company made. So a reconciliation is when we reconcile the balance per bank to the balance per books. And so to the bank balance, what we're going to do is add any deposits in transit, subtract out any outstanding checks, and then plus or minus any bank errors. On the balance per books over on this side, we're going to start with our balance per books, add any collections the bank made, subtract out any NSF or bounce checks, any printing charges, other service charges, and then plus or minus any errors that the company makes. Here's an example. The bank balance for Laird Company, for which the company accessed online. It shows a balance per bank. In other words, the bank statement shows this much on April 30th. But on the books, we had this amount. So notice that the two amounts that they have there are different. So step one, we're going to take the deposits in transit, and then we're going to take all the outstanding checks and whenever errors were made and any bank memoranda that they came to us. So we start with our balance per bank, add in deposits in transit, subtract out outstanding checks. That's the same thing we do every time. Then we take our balance per books, any errors that were made, subtract out any non-sufficient funds, and any bank service charges, and add any collections of notes. And those two numbers at that point should be the same. Once you do that, the numbers should tie together. Now, anything that we do over on the book side, so all of these things that we did over here, all of these four things, we're going to have to make journal entries for because our books are not correct. So we need to adjust it from where it is down to where it needs to be. And to do that, we need to record adjusting entries for all four of these things. So here are the adjusting entries. To record the collection of the note, we debit cash. to record the expense, which would be like the service charge, and the collection of the note and the interest revenue on the note. The book error, well, the book error was made and on account to Andrea Company, a supplier, so we know that would be accounts payable misstated. And the non-sufficient funds check, what we would have done is had to put that back into accounts receivable. We thought we had collected, but really they didn't pay. And finally, the bank service charge, we're going to record as the miscellaneous expense. And then you see, once all those entries that you make, then you post them. We're just posting like we did back in chapter 2 and 3. We're posting those entries, and then it gets you the number that we had in our reconciliation. That's the number we showed there. The reconciling item in a bank reconciliation that will result in an adjusting entry by the depositor, that is the company, is what? Well, it's one of those things on the adjustment to the book side. The outstanding checks, deposits in transit, and service charge are all on the bank side. So therefore, I said bank service charge, I meant bank error. Reason why we have to record this, we need an adjusting entry because the bank charges us something and we have yet to report it. So we need to get it onto our books. And then the electronic funds, anytime we're using a wire, telephone, computer, whatever it is that we're besides cash that we're using, they normally result in better internal control because no cash or checks are handled. So there's no way to make a mistake in the middle, or steal it, I should say. Once you get cash or check into an employee's hands, it's vulnerable. So, Sally Kist owns Linen Kist Fabric. Sally asks you to explain how she should treat each of the following reconciling items when reconciling the bank account. A debit memorandum for a non-sufficient funds check, a credit memorandum for a note collected, outstanding checks, and a deposit in transit. Non-sufficient funds checks is going to be deducted from the balance per books because we have not we recorded like we received it, so we need to get it off of the books. Collection of a note, we have to add that to our balance per books. Outstanding checks is deducted from the balance per bank, and the deposit in transit is added. And remember, anything that we do to the book side, we're going to have to make journal entries for. Cash equivalents are short-term, highly liquid investments. In other words, they're things that are very close to cash. They're not cash, but they're very close to cash. So they're readily convertible into cash, and the maturity that their market value is relatively insensitive to changes in interest rates. Restricted cash is cash that's not available for general use, but is restricted for a particular purpose. For example, you might have a payroll bank account, and it can only be used to pay the payroll. And so you can see this is the actual Delta Airlines that they have cash and cash equivalents. Those are cash and items very close to cash, like a treasury bond. And then we have restricted cash shown separately. Remember, those are items that can only be used for a particular purpose. Which of the following statements correctly describes reporting of cash? Well, cash is listed first in the current assets section. In A, it says cash cannot be combined with cash equivalents. Some companies do combine them. Restricted funds may be combined, and no, they cannot, because one is restricted and one isn't. And then restricted cash funds cannot be reported. Well, yes, they can be reported as a current asset. Well, let's talk about the basic principles of cash management. That is, you start a company, you own a company. Cash management is the cash coming in and cash leaving. You need cash on hand to pay the bills and such. So the basic principle is you want to increase the speed of receivables collection. You want to collect your receivables as fast as possible. Keep your inventory low so you're not having to pay for warehouse space and insurance and such. Monitor the payment of liabilities to make sure you pay them on time and take advantage of discounts. And plan the timing of major expenses. Major expense, like for example in this picture, we have expanding the factory. You want to plan the timing so you have the cash available, and any idle cash you have, you should invest it. And many companies prepare what's called a cash budget. Here's an example of one. Now we're not going to go in depth in this in Principles of Accounting 2, you go much deeper. But the gist of it is where you show it's a budget of how cash comes in and cash goes out, typically over 1 or 2 periods. Like this example is over the years, goes by each quarter. And it helps you to have more effective cash management. So it shows you your cash receipts, the cash coming in, and your cash going out, and then how you spent. What did you spend this cash on? Then we have what's called a petty cash fund. Petty cash fund, we said before that you want to pay almost everything you can with checks or wire transfers, electronics fund transfers, but sometimes you just need some cash around to pay last minute kinds of things, like if you have a delivery that you have to pay for, if you need some supplies you need to pay cash for, whatever, that kind of thing. So if they decide to establish a $100 fund just to have cash around, just to keep track of it, then basically what you do is set up a separate cash account called petty cash. And then assume that the petty cash custodian requests a check, and that's to cover the funds that went out, and it had $13 cash and the receipts. So they bought postage, supplies, and miscellaneous expenses. So postage, supplies, miscellaneous expenses, and the cash going out. So that it's a fairly simple process, but good internal controls over the cash. Assume in the preceding example that the custodian only had $12 in cash. What's the problem? You were short, and so we use an account called cash over and short to make up the difference. That's basically meaning that you didn't have the cash. As long as it's a small amount, then you don't get real excited about it, but you keep an eye on that. Looking at IFRS, the number of companies reporting fraud increased from 37% to 45%, which is a 22% increase in reported fraud since 2003. The cost of the company was an average $1.7 million. That's per company from tangible frauds. That is, those that realize an immediate and direct financial loss, like stealing cash. This includes asset misappropriation, which is a fancy term for stealing, theft, false pretenses, and counterfeiting. Non-U.S. companies that follow IFRS are not required to follow SOX. We mentioned SOX earlier. That is a U.S. standard. So if you're a non-U.S. company and you're not using U.S. GAAP, you don't have to follow SOX. However, the Sarbanes-Oxley Act applies to all U.S. companies listed on U.S. Stock Exchange. Well, that concludes Chapter 7, and we'll talk to you soon.